Exercise 3.7 is asking us to do some adjusting entries. Now remember, when you're doing an adjusting entry, what you're doing is you're taking funds out of a bucket called either prepaid, as in prepaid insurance, prepaid rent, prepaid taxes, prepaid baklava, whatever, and you're moving it over into the related expense bucket. We also do the same thing with accruals, which we call payables. We also call them liabilities, and the most common one that you'll do with that is unearned revenue, and that comes over here into another bucket called revenue. So that's what we're doing, taking it from one bucket to another. The trick is to figure out how much. So let's get started. And of course, when we do these, the easiest way to do these is with T accounts. So let's take a look at our supplies. That's supplies, that's our asset account. And that's linked over here to our supply expense account. You got to make sure you get the last names of these accounts. So, our supplies at the beginning of November were $2,000. Our supplies at the end of December were $3,500. And during the month of December, we bought $4,500 worth of supplies. So what it's asking you to do is to determine what would be this number and this number. So what would be the supply expense? What would be the supply asset that's reduced? Well, we had 65, we ended up with 35, so it had to be 3,000. So we'll debit supply expense, 3,000, credit supplies the asset account, 3,000. Next one's very similar. It's insurance expense and prepaid insurance. So let's get our little picture up here. We have insurance prepaid, the asset, and we have insurance expense. And it tells us that at the end of November, November 30 or December 1, we had $8,000 in prepaid insurance, and at the end of the month we had $6,000 in prepaid insurance, and we made no insurance payments. So again, we're looking for this number right here. So if we had $8,000 and we ended up with $6,000, clearly $2,000 was used up. That's a $2,000 credit to prepaid insurance, a $2,000 debit to insurance expense. Now the next one's a little tricky. It's not tricky like in number tricky, it's tricky like in you got to read the bloody question tricky. They tell us that we paid $11,000 in December for November salaries. That's leading you to think that somehow we have to recognize that $11,000. You want to debit salaries expense or whatever. That's not what you need to do here. You can ignore that piece completely, because when you paid those salaries, here's what you did. You debited salaries payable, $11,000, and you credited cash, $11,000. So all we're doing here is we're recognizing December's salaries payable, and that's simply a debit to salaries expense of $16,000 credit salaries payable $16,000. To be consistent, let me go back and write in our insurance expense journal entry. We did it here. Just going to copy that information over. Debit prepaid insurance $2,000, credit insurance, or I'm sorry, debit insurance expense $2,000, credit prepaid insurance $2,000. And then last but not least, this company had somebody rent something from us. What would they rent? Property insurance or something? No, they advanced rent. They rented a piece of our building. So they rented a building from us for $4,500 for 3 months. So the rent for that building was $1,500 per month. Okay? So the buckets here are the ones we talked down here. We have the unearned and the revenue. And it's just a simple 1 month journal entry. We debit deferred revenue, $1,500. We've earned that 1 month, and we credit our revenue account $1,500 because we've earned that. So if you wanted to look at it in T accounts, it tells us that at the December 1st, in our unearned or deferred revenue, we had a balance of $3,000, and at the end of the period we had a balance of $1,500. This is linked to the revenue account, and it's asking us what is this number, and that number is $1,500. Debit unearned revenue, deferred revenue, $1,500. Credit earned revenue, or just revenue, $1,500.